Hi, I'm Brandon Wells, president of the group, and I'd like to welcome you here. First, I'd like to start by saying, 2020 has been an extremely challenging year. This year, the importance of home came front and center. The place that we protected our families, the place that we quarantined, the place that we learned a lot. It's where we're educating our children and doing many other things. It's been challenging from the standpoint, and I'd like to thank and recognize all of our frontline workers. I'd like to recognize our educators and all of the firefighters that fought to keep us safe and healthy here in Northern Colorado. The group is a locally owned and operated company that's been in Northern Colorado since 1976. And our purpose here is to build lasting relationships and to give back to our community when in need. This year alone, when many nonprofits struggled to bring in money necessary to provide for many great causes, our group partners and their families were able in October alone to donate more than $340,000 to our United Way giving campaign. That money flows back into our community through the various nonprofits. In December alone, Neighbor to Neighbor, an organization that has fought hard this year to help many tenants and homeowners who have struggled to pay their rent, to pay their mortgage, to solidify that place that we call home. We heard that call, and our group partners in the last couple of weeks have raised more than $30,000 to be able to provide and help and assist in that effort. While we know that 2020 represented many challenges, it also brought us together as a community. And there's a lot of hope for 2021. And I think we all can say we're very fortunate and blessed to live here in Northern Colorado. We hope that you enjoy our annual forecast, and thank you for being here with us. Hello and welcome. We're very grateful for the opportunity this year to be able to provide our residential real estate forecast for Northern Colorado. And while much of 2020 has looked very different, so does our forecast this year. But we're very fortunate from the standpoint of utilizing technology to bring you guys the insights of what's to come of the future of Northern Colorado real estate, and also to take a look back at how we've done this past year in 2020 as it pertains to your interests in Northern Colorado real estate. So I'm very grateful and very fortunate to be able to stand up here in representation of all of my peers and partners at the group. My name is Brandon Wells. I am the president and CEO, and all of the insights that you will hear and see tonight are really formulated out of the many years of experience and all of the partners at the group and all of their expertise in helping more than 4,600 families throughout Northern Colorado in the past year find and realize their dreams of home ownership or whatever their needs are as it pertains to that. So all of this information, we hope that you'll find valuable and insightful. I'll familiarize you with the information, and then we'll move a little bit faster as I go through looking and highlighting the different areas as we go through tonight's presentation. So let's go ahead and get started. First off, as I said, my name's Brandon Wells, the president and CEO. I'm very fortunate and thankful to be here with you this evening. If you've never been to a forecast before, the first thing that we do is we're going to start out and highlight what 2020 has looked like and how it shaped up for many of our Northern Colorado regions and cities. So let's first off start with Fort Collins. And what we're looking at is the comparison year over year of residential, attached, and detached average sales price. Now, it's important to note that the figures that you see here are not representative of appreciation, but it's really representative of the ebbs and flows of average sales price in each area that we're going to be talking about. So taking a look at this data, we have data here all the way back to 2017, showing that Fort Collins was just on the cusp of eclipsing $400,000 in average sales price. And if we look at 2019, just a year ago, we were at $431,000. Moving forward to 2020, we saw an 8.7% jump in the average sales price for the Fort Collins area. Now, it's really interesting to pay attention to, and we'll talk about this theme as we go through tonight's presentation. Really, a primary driver in the Fort Collins market was high-end luxury properties, nearly doubling in sales, which has had a major impact on both average and median price accelerating in the region. We will also talk about appreciation and what you can expect from that standpoint, looking at historical perspectives, as well as what we've seen through 2020. So let's take a look at some of the supply and demand, and this is really looking at the inventory of homes, which has been a constant narrative in 2020. We really sat here a year ago at the Embassy Suites with many of you in person and talked about how low and dire our inventory situation was. We never had any foresight that we could see inventory really reduced by about 50% on top of where we were last year, but that's very much what has happened and really the narrative that has helped shape what has happened in terms of prices and supply and demand in the region. So looking at Fort Collins, if we look at the number of available homes for sale in Fort Collins as we start 2021, last year in 2019, we were starting off the year with about 366 homes for sale. This year, we're down 52% with only 175 homes for sale. Looking at the number of homes sold for the year, we eclipsed 3,000 homes sold in Fort Collins, and that was up 9%. So very strong growth for the region as we saw it play out in 2020. Looking at the Loveland marketplace. So a year ago, Loveland had just gone over the $400,000 mark at $409,000. And now this year finds average sales price at $425,643, and that represents a 4% increase. Now, many of you might be sitting at home asking, why such a difference or variation in Fort Collins to Loveland? And really the impact, as I said before, on luxury real estate. About the same number of $1 million plus properties sold in Loveland as did a year ago, where if you look at Fort Collins and other region cities, they doubled in terms of those number of luxury sales, really creating a big pull on average sales price going north. So let's look at supply and demand for Loveland. Very similar situation with inventory down about 45% as we come into the new year. There's only 128 available homes on the market in Loveland. And then looking at the number of homes sold, Loveland saw a nice increase of 13%, just shy of the 2,000 homes sold mark for the year at 1975. We'll take a look at the Greeley and Evans market. Greeley and Evans last year had just gone over the 300,000 threshold for average price, and this year up to $321,195. That represented a 6.1% increase in average price. Let's look at the inventory situation in Greeley and Evans. So starting the year with only 148 homes on the market, that is down 42% from a year ago at this time. Looking at the number of homes sold, down 4% to 2,150. Now, Greeley is an interesting market because Greeley also has felt a lot of the impact of the pandemic, but has also had kind of a double whammy with what had happened to oil prices as we went into the middle of the summer months. And so a lot of oil and gas impact in terms of economics in that marketplace as well. We'll look at Windsor and Severance. Windsor and Severance, as we talk about a lot of the development epicenters of northern Colorado, for many years past, we've talked about Severance being a prime area for growth in our region, as well as Windsor with the introduction of the rain dance community. Many of those projects were slated to be 10 to maybe 15-year projects to be seen all the way through their build-out phase. And what we've seen instead was really a shortened timeline of the absorption due to really heavy and strong demand and really a lack of inventory driving a lot of those metrics. So if you reflect back here to 2018, we saw a decrease in the average sales price by about 4.7%. And that was the influx of a lot of more entry-level pricing in some of those new construction areas. As we've gone through the last 2 years, last year we ended the year at $421,000, and in 2020 we saw a jump of 5.6% in average sales price up to $444,000 as Windsor and Severance really becomes a larger market in our region. Looking at the number of homes for sale, so we've got 202 homes for sale to start the year, down from 383, which represents a 47% decrease in available inventory. Looking at the number of homes sold, this was up 17%. So this jumped up to 1,919. And this makes these two markets combined about the same exact size as respect to real estate transactions as the Loveland market. It's a big storyline as we've seen. And really the areas that had available inventory saw heightened levels of demand because they were able to satisfy new homes for people looking in the region. We've always joked in the past as, you need to drive until you can qualify. And really this year, the storyline has been you need to drive to where you can find a home because inventory has been so dire. Let's look at the Timnath market. So Timnath, a smaller market in terms of statistics, but really an important market as we talk about the future growth epicenters of Northern Colorado. A lot of movement in that market, and really it's kind of been primed as a luxury or affluent developments with things like Harmony Club continuing new phases of that development, Wild Wing around the Timnath Reservoir, Timnath Ranch really coming to maturity and some of those properties turning over, but a big pipeline of future development as well. So looking at the average price, obviously with some of those higher end luxury communities, we see a much higher average price point. Last year, we ended the year at $571,000. We're up to about $600,000 right at there, and that's up 5%. Now, again, as we've talked about the luxury market having a big pull on average prices, Timnath doubled in the number of $1 million plus properties that sold. And so we've seen that pull that average up with new phases in Harmony Club and a lot of other development having an impact in that marketplace. Let's look at supply and demand for Timnath. So homes for sale in December as we start. Last year, we had 117 homes available to start the year. This year, down 57% with only 50 available homes on the market. Looking at number of homes sold, a 32% increase. Now keep in mind that this is statistically a smaller market when we're comparing it to markets that have, sales of 2,000 annually. But we continue to see this trend in these growth markets of really high growth percentages as we jumped up from 289 homes sold a year ago up to 380, and we expect that trend to continue moving into the future. Looking at Wellington, going up north, Wellington saw an increase from 356,316 up to 382,603. And that represents a 7.4% increase in average sales price. That's a very substantial increase. Now, Wellington is not a market that's known for really high-end properties or luxury movement, but we have seen a lot of the impact of pricing in other areas and lack of supply lead to price escalations in that marketplace. Looking at supply versus demand here, number of homes for sale in December was down right about 50%, 49%, going down from 71 available in 2019, or as we started 2020, down to as we start 2021 with only 36 homes available on the market. Looking at the number of homes sold, we jumped up from 410 to 427 homes sold, which is a modest 4% increase. Still what would be expected without a lot of new development, a lot of projects finishing up there from certain builders. And we'll talk a little bit more about Wellington as we get into some of our stories around development and new construction. Looking at the Berthoud marketplace, this has been a marketplace that we have talked about a lot over the past 3 years of forecasts of really being kind of the squeeze epicenter market of growth. It has felt the squeeze of a lot of the Boulder and Longmont marketplace, as well as the Loveland and Fort Collins marketplace, putting pressure as people find one of the last infill communities that is on the west side of I-25. With the development of the TPC of Colorado, a lot of luxury real estate with those beautiful views of Longs Peak, have gone in there, and we've seen that market really grow and flourish over the past several years, and expect that trend to continue as it's very sought after. Prices jumped from $463,987 a year ago up to $491,645. So just shy of that $500,000 average price point and an increase of 6% this year. Looking at the supply here, homes for sale, only 61, down 47%, so right in line with the trend line of other markets. And the number of homes sold in that marketplace was up 24%. Again, a market that did have inventory to match that demand need here in Northern Colorado. Looking at Johnstown, 410,788 a year ago, up to 417,648 this year, 1.7% increase. Many of you might ask, well, why didn't we see the same average price point? Well, when you look at Johnstown, you don't see a lot of that upper end inventory. So it hasn't had the same impact as other markets of seeing really high price point purchases throughout the year. But still seeing a lot of the impacts, down 65% in available inventory. And just simple economics states that will put north pressure on prices as we lack opportunities to match demand. And then looking at the number of homes sold was up 3% from 409 to 420 in 2020. Going down south to Longmont. Longmont obviously jumping from 474 up to 528. This was the largest mover in our marketplaces in Northern Colorado, up 11.5%. And really what I attribute this to is a lot of the reshuffling that occurred as people tried to find more house, potentially more acreage as their priorities or their living desires shifted as a result of the pandemic. And Longmont represented kind of an outflow opportunity to find some of those more house opportunities, larger footprint acreage that many people might have been looking for through the pandemic. Taking a look at supply and demand, supply is down 65% as we start the year, only 88 homes on the market down there, as opposed to 247 a year ago. That's a very different marketplace to start 2021. And then looking at the number of homes sold, right in line about 2%. So really with inventorying being as low, number of homes sold are very much challenged in some of these markets and will be across Northern Colorado because we just don't have enough homes to sell, and we're really relying upon new construction or resale churn that would bring properties back to the market. Looking at the Boulder marketplace, 923,000 a year ago, up to 952,534 this year. That's 3.1% increase in average price. And then looking at the inventory, down 26%, so not as big of an inventory shift from a year ago. And then looking at homes sold, this was up 11%, so strong growth still in the Boulder marketplace, even with really high prices, the highest in our region. Look at Alt, Eaton, Kersey, LaSalle, Meade, and Milliken. And I'd like to make a note that as marketplaces become bigger, we do break them out statistically. So in years past, we've broken out Berthoud, we've broken out Timnath, we've broken out Johnstown. We may look to break these other regions out, but right now we do lump them together. If you're interested in getting any data or insights about one specific market, you certainly can reach out to your trusted advisor here, your group realtor, that can provide any information for a market that we may not have covered tonight. So looking at this marketplace, up from 373,000, just shy of the $400,000 mark at 399,483 this year. That 6.9% increase. And looking at supply and demand, so number of homes for sale at 67, so down 33% from a year ago. And then looking at the number of homes sold, really just flat from a year ago. And so a lot of these marketplaces, Meade specifically has some new construction, which is pulling those prices northward. But a lot of those other areas, small development, but not the huge, massive growth that we've seen in certain other markets. So let's talk a little bit about how we performed in our forecast. So every year, a fun part of this forecast is our projections. And it's not just a shot in the dark. We take all of the insights from all of our incredible partners. We talk to a lot of our industry peers, from builders to other brokerages, and really get a feel for the marketplace so that we can try to provide the best and most accurate insights that we can to you. So let's reflect and look back at the number of home sales in Northern Colorado. So our 2020 prediction was 10,900, and that prediction was really a little bit, conservative because we were concerned about inventory having that same, concern as we're starting this year. But little did we know that inventory could go even lower, and we didn't know where a lot of those sales would come from. So what the 2020 actual was is we ended up selling 11,685 homes in Northern Colorado. This does, by the way, exclude the Longmont and Boulder marketplace. So this is all of our other Northern Colorado communities. And that gave the group a 93% accuracy. Now, our accuracy took a little bit of a hit this year, but if I was to tell everybody at home that you had to forecast and predict a global pandemic at the scale of what we've endured this year, I feel pretty satisfied with our accuracy, given a lot of the circumstances of shutdowns and other things that have occurred. Looking forward to our 2021 forecast. It's important to note that a lot of organizations like the National Association of Realtors are forecasting nationwide 10% growth in number of home sales. Other organizations are, a little bit more modest at about 6%. We do feel like some of our supply is going to be very, constrained. A lot of our development roadmap is more pushed out to 2022. So we see growth more in the neighborhood of about 5%, up to 12,195 homes sold in the region. So we'll come back a year from now, we'll see how we did in terms of our accuracy, but kind of what our expectation is in number of homes sold. Let's take a look at average price and see how we did. So last year, our prediction on average price was $424,761. The actual was $439,117, and that represents a 97% accuracy in our ability to kind of put a target or a pinpoint on average price in Northern Colorado. Moving forward to our 2021 forecast, we believe a lot of the same things, and you're going to hear this through the narrative of our stories tonight as we talk about our forecast, but great growth up to 461,667 for 2021. So now what I would like to do is I'd like to shift gears a little bit, and I hope you enjoyed that recap of 2020, but I'd like to talk about some of the storylines and trends that we believe are shaping the marketplace for our region moving forward. So first off, I want to talk about employment. Now, a couple things that are really important about employment. You have always heard us say at any of these forecasts that employment is usually about a 12 to 18 month leading indicator of economic conditions. Now, what we have witnessed this year is some of the most disruptive forces to our employment numbers and a lot of turbulence of truthfully understanding what is happening regionally and what's happening at a national scale, as we had a lot of forced shutdowns, a lot of people filing for unemployment. And so employment numbers have never seen the volatility like we had seen this year. But our region is really formulated on a lot of employment and a lot of great employers, from healthcare to education, and really the majority impact of employment has been felt in the hospitality and leisure sector. Most of those jobs and most of the unemployed numbers have come from the private sector in hospitality and leisure. But let's take a look at the comparison. Now, all of this data, like most of our forecasts, is only current through November because we don't yet have the Colorado Department of Labor and Employment data through year end. So we'll make our comparison and I'll catch you back up on where we went from last year's conversation. So Larimer County last year in 2019 had a growth rate of about 2.4%. And obviously with the retraction of the number of employed, that has gone down from 207,000 down to 192,000 as we sit here today. That represents a growth rate of negative 7.2%. Looking at the unemployment rate was really, really low and probably some of the lowest in the country at 2% in 2019. And we're now currently at 5.2%. Where nationally we're hovering more in the 6% range. So we're doing great as a region. A couple of really important caveats here as well is there's a lot of claims right now of fraud in the Colorado system for unemployment, and that really has had an impact on the ebb and flow in numbers. So it will take some time to sift out through some of this. But I want to talk about, kind of what the loss was or the impact of the pandemic, which for most of these marketplaces was through April. So if we reflect back, November was the high water mark for Larimer County at 207,242 employed. And April was the low point. We lost 13.7% of our number of employed, and that got down to 178,807. And we talked a lot at the beginning of this of what type of recovery. A lot of economists talked about, would industries see a V-shaped recovery? Would the shutdowns be just a shutdown and a dip right back out? Would we see a little bit more of a W, a double dip recovery? Would we see a K-shaped recovery where certain industries skyrocket and other industries suffer? A lot of that will come out in the shuffle as economists analyze everything. But what you see is we've had a strong rebound from April, really recapturing 7.6% is the increase from the low water mark in April of 178,000. We're back up to 192,000. But I don't want to diminish the fact that we have some employment challenges as it pertains to small business, as it pertains to businesses that were impacted in various different ways. But our county continues, Larimer County and all of our counties continue to perform very well in their recapture and their recovery. But we got a long way to go and we need all the help we can get. So I'm grateful for the chambers and all the people doing the work across the region to really make some impact and inroads on helping us get back to getting most of those people back employed. Let's look at Weld County. So Weld County, growth rate of 3.6 a year ago. Now we're at a negative growth rate of 6.3 to be expected. We were at 169,000 employed last year in November. This year, 159,000. Unemployment rate currently sits at 6.4%. Like I mentioned earlier with the Greeley and Evans comments, Weld certainly has felt a little bit more of not only the pandemic, but of the oil price conditions in oil and gas. And that has always had a shift on their marketplace. So a little bit higher unemployment rate in that region as a result of there. So looking at that, the pandemic impact from November at 169,000 down to April of really, the reduction of employment because of shutdowns and just, the pandemic. That was a 12.8% decrease in the number of employed. But from that timeline of April moving forward to November now, we've seen a 7.4% increase from that low water mark in April. Let's take a look at Boulder County down south. Has a negative 6.2% growth rate. We saw a number of employed go from 194,000 down to 182,000. Unemployment rate has gone from 2% a year ago up to 5.1%. And then very similar trend line of, really a sharp dip and then kind of trending itself back up. A lot of the changes of policy of going from, status orange to red in a lot of these counties has had an impact on the number of employed as employers have ramped back up, shut back down again, opened back up, pivoted, shifted the way they do business. And I commend each and every one of you out there who is either employed or is working as an employer on your resilience and really trying to fight through and figure out ways that you can keep your businesses operational. So I commend you on your efforts. So let's look at the total. What does this mean? Well, employment drop, what represented for Northern Colorado between Larimer, Weld, and Boulder is, from November of a year ago to April of really the prime impact, we lost 70,000 employed. 28,000 in Larimer, 21,000 in Weld, and 20,000 in Boulder. But our recovery has been great. We've seen, I think you got to look at the bright side here of 13,000 employed gained from June to November, 11,000 back to work gained in Weld, and 8,000 back to work gained in Boulder for, back to 32,000. And when you look at that, it's pretty amazing for the impact that we've felt. We've seen really a recapture of those employment of about 46%. So don't want to diminish that we got a long way to go, and we certainly will probably have some headwinds ahead. But to be sitting here less than a year later saying we've recaptured 46% of that employment. But, as we've said, it's important to watch, from the standpoint of region economics, that this will have an impact, and it does have a lagging impact on our marketplaces. One of the things that I think has been a storyline for Northern Colorado and is when I talk about reshuffling is it's not always just about jobs that are centered and based here. With the mobility of workforce, we have seen more people choose the quality of life through life events of whether it's been living in a city, whether it's been some of their way of life being altered or changed. The importance of home has changed for so many people, and many people have found employment opportunities with people that aren't even based here. They're based out of other parts of the country, but they're able to run their business as independent operators, or they're able to work for an employer that is allowing them to work remotely, and they're choosing quality of life in our region. So that certainly is a storyline that's made up 2020. The last thing I want to show you is the comparison. So this is the unemployment rate comparison, and this basically layers Larimer County, Weld County in basically over on a graph looking at the national. So, the national unemployment rate in April was 14.8%, something we had not ever seen. But you can see in red and in blue here that Weld and Larimer County had performed well better than the nation as a whole, and continue to perform very well as our unemployment numbers are much lower than where we are nationally. And I think that continues to be a trend for Colorado of being a desirable place for both businesses as well as people to reside and live. Now I'm going to pass it over to a great friend of mine, somebody I respect immensely, who you've heard from many of the last year's forecasts, and he's here today to talk about interest rates. So I'd like to introduce you to Jason Pfeiffer, our president of Group Mortgage.
Thanks, Brandon. And thanks for tuning in. As Brandon mentioned, I'm Jason Pfeiffer with the Group Mortgage and here to share our interest rate forecast. But I think it's important that we look back at 2020 because so much what unraveled that year laid the foundation for where we find ourselves today and where we're likely to go throughout the next year. Last year, we ended up thinking we were at the tail end of the refinance wave. Interest rates were about 3.64, and when I was going over the forecast, we really thought we were at the end of the refinances. However, with many forecasts, this one didn't remain true. And what we saw was interest rates continued to trickle down at the start of the year. However, about the second week of March is where interest rates went berserk. And I think that might be the technical term, but I'm not sure. And this graph doesn't really do it justice. This is a weekly graph of what interest rates did. But what we experienced during those weeks in the part of March when we realized the significance of the pandemic was intraday movements of interest rates of nearly 0.75% in one day. Literally, you'd call up a borrower, say they had the option to save a few $100s on their mortgage. By the time you were actually able to connect with them, there was a good chance rates were higher than where they were in the current mortgage. Another thing was people would look out to buy a home. You'd go through payment scenarios, and by the time the contract was put together, they were likely to see rates and payments a couple $100s higher than what they expected. Fortunately, at this time is when the Fed stepped in. And what they did is they dropped the Fed funds rate, but more importantly for mortgage rates, they started buying mortgage-backed securities and other assets. They expanded their balance sheet, and that provided the stability and the liquidity that we needed in the marketplace. And we saw rates kind of trickle down throughout the year from there. So with that, we really still had some headwinds that we faced as far as a mortgage industry. So the low rates and the unbelievable opportunity to buy the house you wanted created a capacity issue. We weren't staffed in order to handle all these loans. And so that kind of gave us a black eye and some concerns as far as clients going frustrated with the process. In addition, we had new COVID requirements that mandate that we check your employment right before closing and we make sure that your income is still at a stable level because so many people were furloughed. We had to make sure you had the ability to repay that loan. So those were black eyes on us as far as an industry goes. I'm really hopeful that when we look back on this, we'll recognize the impact that the mortgage industry had on the overall recovery. When you think about a refinance that might save someone $250 or $300 a month, they're going to save that each and every month. That is a huge stimulus. And moving forward, that's going to be something that they have extra discretionary income to spend on dining or travel for years to come. So speaking of years to come, the general consensus amongst most of the experts is that interest rates will go up. I feel like we've been saying that for a very, very long time. But if you look at the National Association of Realtors, the Home Builders Association, Mortgage Bankers Association, Freddie Mac, Fannie Mae, or Realtor.com, all of them have upward pressure on rates, but fairly moderate, only looking at a little over 3% towards the end of the year. If you put that out a little bit further out, the Mortgage Bankers Association forecasts rates throughout 2023 to remain below 4%. So overall, we still have a very accommodative interest rate policy, and most of that has to do with the Fed supporting through asset purchases and through buying mortgage-backed securities. However, I don't want to discount the impact of mortgage rates on overall affordability. So just for fun, we worked up this example, which is the purchase of a $450,000 home with 20% down or a $360,000 loan amount. If you look back at the 70s when interest rates were at 8.86%, this led to a payment of $2,860 plus your taxes and insurance. In the 80s when we were at 12.7, that was nearly $3,900. At the end of the year when rates had dropped down to 2.65%, that dropped all the way down to $1,451. Now I recognize that a $450,000 home in the 70s and 80s was more of an estate, but I hope your takeaway is how interest rate impact the overall affordability. Our prices have gone up, but relatively with a drop in interest rates, we still are relatively affordable. Another thing that's contributed to our affordability is the conforming loan limits. I shared this slide with you last year, but I think it's still relevant today. The conforming loan limit for a decade maintained at about $417,000, but over the past 5 years, we've seen that jump up over $548,000. And as our prices creep up, generally speaking, conforming loans have a lower interest rate and more lenient underwriting and approval guidelines. So this will provide clients with a great option. So all in all, with interest rates at some of the lowest levels of all time and the highest conforming, now's a great time to get a home loan. We do forecast interest rates to rise, but generally speaking, with the continued support of the Fed buying mortgage-backed securities and being very intentional about keeping interest rates low. They've started that since the pandemic, and I think it's real estate and keeping these interest rates low that they are continued to focus on. So keep your eye on them, and having said that, I'll turn it back over to Brandon. Thank you.
Thank you, Jason. Great insight and information as always. Next, I want to talk about our third story, and that's really the Great Reshuffle. We've talked a lot in years past about the Great Recession. Obviously, in 2005, 2006, an impact that had massive impact on the real estate industry, and an economic recession. And we're, by definition, in a recession again. But I call this one the Great Reshuffle. And one, we've been very fortunate as an industry to really lead the charge out of this recession. We've been greatly fortunate that people's importance on the place they call home and really the safety of where they call home, and that being the place that they were locked up in quarantine, where they were spending time, where they're running their businesses, where they're educating their children, and they're kind of waiting out that pandemic, has led to a lot of reshuffling of people's priorities or their quality or way of life. We've talked a lot about the impact that this has had on some of the larger cities. And, right on the onset, many people talked about the fleeing from cities as people were headed to the suburbs. That way of life that so many people had, built around this idea of live small, rent a space in a big city, use all the nightlife, all the restaurants, all of those things from the standpoint of quality of life. That really came to a screeching halt for many people. And they reassessed some of those living environments. And while I think it has been overstated from the onset, I do think that there is a massive amount of people that have really changed their living environment as a result of this. And this is one of those reshuffles that isn't just a couple of year thing. This is one of those shifts that will have generational impact as we look back of the impact that COVID-19 and this pandemic has had. But we've seen a lot of people looking for quality of life, the ability to work mobility and employers offering mobility. A lot of projections out there state that, while people will get back to working in those environments, there are a lot of people that have said in surveys that they, have enjoyed being able to work and having a little bit different quality of life. And I think that will change forever the landscape as we see it and as it pertains to home ownership. So a couple of the trends here in this reshuffle that we've seen is, for many years we talked about really people didn't want these McMansions. They wanted open floor plans, but smaller, not a lot of work. And what we've seen through this is really some buying trends that signify that people are wanting a little bit more separation of space. They're needing places where they can call their home office, where they can call their gym, where they can do a little bit more recreation with yard space. We're also seeing that people are having to educate their children, and so having space for their children to learn and grow has become a priority. On the onset, many of us were using our kitchen tables to try to educate and quickly realized that wasn't the best learning environment. And so many people, that have had the opportunity and the ability to do so have restructured. And much like Jason talked about, the ability to do so has come from affordability of interest rates. We talk about the 10% rule, and really if you look back just a couple of years ago, we're talking about a 20% increase in affordability to somebody that is looking at potentially moving up or moving into their home of their dreams. And that's really changed and reshuffled things for people. One of the other big storylines that has shaped this year is the luxury impact. The people who have built up substantial equity in home ownership and have ridden a lot of this economic growth wave over the last decade of this expansionary economy, also with the coupling of rates, has lent to a lot of people buying larger properties. One of the trends that also doesn't get a lot of airtime or spoken about is we're talking about stimulus to the economy. Jason talks about the Fed buying back mortgage-backed securities. But if the average homeowner, like he said, essentially refinanced in this wave of low interest rates, they got an infusion of, let's say $200 or $300 per month for the next 30 years. That's a pretty healthy stimulus that was injected into the economy. And people utilize that money to go out and look at ways that they could afford that home of their dreams or giving themselves that move-up opportunity. In looking here at Larimer County's $1 million plus sales for 2020 and looking comparatively over a year ago, in 2019, we had 118 properties that sold in Larimer County over $1 million. In 2020, that increased to 211. So we almost doubled the number of $1 million properties sold. And while the inventory was low, I would expect that trend to continue. Looking at Weld County, we saw $49 million plus sales in 2019, and in 2020 that jumped up to 64. In the marketplaces I mentioned earlier, Fort Collins, Timnath, and Berthoud, and Longmont, all of those marketplaces saw double, basically 2x increases in the number of $1 million plus property sales. And a lot of that is the byproduct of rates, but also the byproduct of people looking and desiring more out of that place that they call home. So we continue to see this shuffling occur and we'll continue to see that. And I think we really maybe underestimated. We always see Fort Collins and Northern Colorado and many of our communities being listed as these #1 places to live. Well, that really rang true as many people had to put that to the test of, based on this, am I in the living environment and the arrangement I want to be in? And I believe that will have an impact. The other thing that needs to be stated is that right now there is 3 million more millennials than were a decade ago. So when we look at the Great Recession versus what I call the Great Reshuffle here, we have 3 million more forming households that are basically in their formative age of home ownership, between 30 and 34 years old. And many of those people are looking to build and grow their families, to start their journey of home ownership, and they're looking out to more of our suburban communities to do so. So let's talk about story 4, and let's talk about appreciation. So when we talk about appreciation, I think it's really important to make mention, as I did earlier, that appreciation is very different than the average price increase. Appreciation, as calculated by the Federal Housing Finance Authority, is really taking and trending the same house over a period of time and then basically giving an insight into what the value of that one home has done. When we talk about average sales price, that's lumping together all of the sales that have occurred and basically taking the average, or if you're using median, of all of that statistical basis. It's not really what has happened to each house in the marketplace. So what you're seeing here is the house price index, and this goes back all the way through, I believe, 1975. And in gray indicates all of the economic recessionary periods when we've had GDP recessions. And right now you see at the peak of this graph in 2020, it's indicated in yellow because currently by definition we are in a recession. And it's important to point out, across all of these, really except for the Great Recession, home prices have continued to increase through a period of economic retraction. And we're seeing the same thing hold true for the current recession that we are in, is that home prices continue to escalate. And with the current situation of lack of inventory, and increase in demand, specifically in all of the country, but us feeling it here, we'll continue to see northward pressure on prices. So let's look at appreciation, and this is for the Fort Collins and Loveland MSA. So the Federal Housing Finance Authority captures this data and releases these quarterly reports, and we take this quarterly information, and this goes back all the way to 1978, showing you the home price appreciation performance for our region. And I'll zoom in and show you the last few years here, but what I'd like you to take away from this is the statistical average for appreciation for our region is 5.4%. That's incredible growth of appreciation for homes. Looking at the last few years, going back to 2010, so a decade look here, I've always talked about, we were really riding a wave of 2015 being the high watermark of double-digit appreciation in our market. And then we started to see this step-down stabilization occur in 2016. As you get all the way, we ended 2019 at 4.2%, so stepping more in line with some of those historical averages. And what you're seeing here in 2020 is not the full year. We won't get that data for the fourth quarter until later in January, February. We'll make sure to put that information out on both the group website, or you can contact your trusted group advisor, and they would be happy to share that information for you. So the 2.6 is not statistically accurate yet, but I would expect this also to jump up in the fourth quarter a little bit more in line with our historical averages, somewhere in the ballpark of where we ended last year. And as I mentioned before, you might say, well, with all of these average price increases, what's the storyline? Appreciation remains strong in our region, and I believe it remains very healthy. The real impact on average prices was the movement in upper end pulling those. Let's look at Greeley and look at their historical perspective. So this one goes back to 1985 for the Greeley MSA, and the average over that period of time through 2020 is 4.5%. If we zoom in a little bit, you can see Greeley also had many years starting in 2014 of double-digit appreciation all the way through 2017. And then in 2018 at 9.3, 2019 down to 3.7, and then so far through 2020 at 3.3. And again, I would expect this to come a little bit more in line with more of our statistical historical perspective here on appreciation, but a healthy market and a market that's growing at a very healthy rate. This slide basically, I want to talk a little bit about, a lot of people think, I wasn't able to get into home ownership, or what's the forecast as we move forward for your expectation on appreciation. So if there's anybody sitting out there watching this saying, I don't know if it's a good time to buy, miss the window. I think everybody generationally can sit there and feel like at certain times when they've bought a house, they've thought, I bought at the top of the market and I'm nervous. But what you're looking at here is a survey called the Home Price Expectation Survey. And this survey went out and it basically surveyed 150 of the top economists in the country, everybody from Harvard to all of the big banks. And it was their perspective on home appreciation for the next coming years. And so essentially, I took a $450,000 house. So I just said, statistically average for our region, so it's pertinent here. If you are able and have the good fortune of being able to afford a home at this price, what would the equity growth look like? And most of those are, projecting modest growth, and they take the median or the average of each one of their projections. And if you bought a $450,000 home in January to start this year, the expected growth is $78,257 in appreciation based on their averages of all of their input by 2026. So the prospects of home ownership remain incredibly strong, and our region remains incredibly strong. Next, let's talk a little bit about supply and demand, and let's take a look at our marketplace as it pertains to the available inventory and months worth of supply that we have. So as I've stated in years past, for anybody not familiar with this, we consider in real estate a balanced market to be about 6 months worth of supply of inventory. So that makes it neutral, not a buyer's market or not a seller's market. Now, currently, with how limited supply is, we've been in a hyper seller's market, which means that there is far fewer homes than there are the amount of buyers out there willing to purchase. And so what that does is that puts incredible competition and pressure in the marketplace for great homes. And it pushes multiple offers in many instances. It also pushes northward pressure on prices. So looking at a balanced market of 6 months, let's see where our marketplaces are and where they continue to go. I think many of you know the answer. And as a new piece this year, what I wanted to showcase is we're going to first start with Fort Collins here under 400,000. And up in the upper corner, you'll see that I've given you a comparison of the available number of homes in that price point a year ago, as pertains to those number of homes in that price point today as we start the year. So looking at Fort Collins under 400,000, last year at this time, we had about 2 months worth of available inventory. We're less than a month of available inventory at 0.7 months under 400,000. Currently, there's only 47 homes on the market in Fort Collins under 400,000 as compared to 126 a year ago. Between 400 and 700,000. Last year, we were at 2.4 months worth of inventory. This year, we're at 1.1 months worth of available inventory. Last year at this time, 165 homes on the market between 400 and 700, and this year, 105 homes in Fort Collins between 400 and 700,000. Now moving forward to Fort Collins, 700 to 1 million. This is the upper portion of the marketplace. And looking at this is very intriguing. Last year, we were technically by definition, a little bit of a buyer's market in this price range at 8 months worth of available inventory or supply of inventory. And then this year, we have less than 1 month, 0.7. This continues the narrative of really that upper end movement in the marketplace. Last year, starting the year, we had 40 homes on the market between this price point. This year, we're starting 2021 with only 10 homes on the market in that price point. Looking at Fort Collins, 1 million to 2 million. So again, last year, we had 15 months worth of available inventory in that price point for the luxury properties. And this year, we're at 4 months worth of available inventory between 1 million and 2 million. Last year, we had 30 homes on the market. This year, we have 16 homes on the market. Looking at Loveland, under 400,000. So Loveland had available inventory and month supply of 2 months. This year, less than a month at 0.9 months worth of available inventory. Last year, 120 homes on the market. This year, 66 homes on the market in that price point under 400,000. Looking at Loveland from 400 to 700,000, last year 2.7 months worth of inventory, down to 1.6 months worth of inventory. 87 homes on the market last year at this time, 45 homes on the market this year between 400 and 700 in Loveland. Now let's take a look at Loveland between 700,000 and 1 million. Last year, we were at 2.8 months of available inventory. This year, we're only at 2 months worth of supply of homes in that 700 to 1 million mark. Last year, we had 10 homes on the market. This year, we have 11 homes on the market. So actually, one more home, but yeah, the reason that the month supply has gone down is because there has been stronger demand in that upper price point in Loveland as well. Loveland, 1 million to 2 million. So last year, we were at 13 months of available inventory. This year, we're at 4. So last year, 13 homes, and this year at 8. So what that tells you there is there are a lot more people in that market, so the demand is stronger. Similar number of house, a little bit shyer, but a strong demand for million-plus properties also in Loveland with fewer to find. Looking at Greeley, so Greeley under 300,000. Last year at 1.3 months worth of available supply. This year at 1 month supply of available inventory. Last year 56 homes on the market. This year under 300, we're at 40 homes available on the market. Looking at Greeley from 300 to 500,000. Last year at 2.4 months worth of supply. This year at less than a month at 0.8 months supply. Really cutting in half from 87 homes available last year between 300 and 500, a prime purchasing band for Greeley, down to 47 homes available this year. Looking at Greeley from 500 to a million. Last year at 1.8, same for this year at 1.8. Last year we had 11 homes and this year we have 14. Greeley not known, but continuing to see more of those types of properties come on to the market as prices move up in that region. Story number 6 that I would really like to talk about is new construction. So new construction has really been the saving grace for our inventory woes across the country. You know, many builders out there, through anecdotally and statistically, have had their best years ever. They have had a hard time keeping up with the influx of demand. Rates have played in their favor. And the lack of available residential resale has played in their favor as well, as many people are not wanting to get into the competitive waters of multiple offers and losing out on properties. And they're looking at new construction opportunities more closely. So it really has driven a lot of people to new construction. The one thing I want to talk about is we're still not at the levels. So people see so much development, and I hear this in comments. I hear this in commentary that gets posted on local media, on stories about how can we sustain as much construction as going on. But to put it into perspective, we're not really even coming close to matching the demand regionally or nationally. For more than a decade, the country has been about 500,000 homes short a year in terms of producing, in terms of new housing starts. So looking back at this trend line, if I go back to the Great Recession of 2005 or 2006, this was the heightened period of really what led to the collapse, as we were overbuilding in a lot of marketplaces at 2.2 million homes or private home starts being started in 2005. But the demand, we had people buying and flying into marketplaces and investing in properties, and really the requirements to borrow. We had many people choosing adjustable rate mortgages. We had many people not even having to have income or proof of income to qualify. If you fast forward now, new housing starts are at about 1.5 million. We're ramping up, but we're still not matching the demand given how dire the residential resale supply is. It just came out a couple weeks ago, in the last week actually, that the U.S. inventory of available homes on the market nationwide is at 700,000 available homes on the market. It's the lowest level in history. So really simple economics tells us, with the demand being as high as it is, we're going to continue to see pressure on prices. Median home price across the country is eclipsing about $350,000, the highest levels seen. And so new construction is really primed for incredible and continued growth. When we talk about new construction, they've also faced a lot of headwinds. And while rates have worked in their favor, they've had many things this year work against them. The cost of lumber has become very prohibitive for many of the builders across the country. Many of the tariffs that were put in place on soft lumber goods and trade with Canada have had a massive impact. As we entered into the middle of the summer months, many of our local builders saw increases to their lumber packs going up by about $15,000. And most of that cost ends up having to be passed through in terms of the cost of the house that people are purchasing. So if we looked at the cost of random lengths framing lumber composite price, I want to show you what happened through the year. So really we started out, and this is the middle of June, this is per 1,000 feet of lumber, was down about $459. It jumped all the way up to $955 per 1,000 feet. Now the good news here is that the US government has reduced those tariffs from 20% down to 9%. And you ask, okay, well then why? And that was back on December 1st. You ask yourself, well, then why are we seeing this massive increase? And the thing that I want to point out about new construction, as Jason and I in a conversation had this week, really last year, the word of the year was social distancing. The word of the year this year is going to be backorder, because many of these new construction builders are facing supply chain issues. So while the cost of lumber, because those tariff reductions have come down, the shutdowns of many plants because of COVID, because of lockdown restrictions, because of the time of year has led to prices increasing again, just based off of supply chain issues. And it doesn't stop here. Many things like appliances or the things like windows that need to be delivered to meet the demand for new construction are very much going to be challenges. And the interesting thing about new construction also is much of that demand is basically recognized. So many of those contracts that were written basically are recognized at the time they're written, and those houses are still yet to be built or in the process of being built. The other thing I'd like to talk about as it pertains to many of our developers and development in Northern Colorado is water. This has really been an important issue and will continue to be an important issue as the volume and the availability of water is one side of the story, but the cost of water. And the cost of water, so much of the water that we obtain for Northern Colorado comes through the Colorado Big Thompson project. And that starts over on the western slope of over in Granby at Lake Granby. And a lot of that water is pumped through pipelines through the Adams Tunnel over here to our reservoirs, Horsetooth Reservoir, Carter Reservoir, and basically utilized for both agriculture, more historically agriculture, but now in more recent times for a lot of these developments. The average cost here of water, the water price per share of CBT or Colorado Big Thompson water. So if you go back to 2009 was $7,000 per share. That cost has gone all the way up to $65,000 per share now. And it's not only that the cost has skyrocketed, but the cost continues to skyrocket because the volume or the availability of water continues to go lower. Many of our communities are offering what is called cash in lieu to our developers. So the developers are able to basically develop a project and pay for the water, both for indoor and outdoor use. And they can offset some of those costs if they're able to bring non-potable water sources into their developments for outdoor use. But that's a challenge. So areas like Wellington. So this has been in the news, and Wellington, obviously, to be able to obtain water for themselves has increased the cost to developers from about $19,000 per water tap up to about $65,000. And that cost has to be absorbed somewhere, and that passes through in the form of prices. So we've seen prices of new construction continue their upward trend, but something that will continue to be a factor as we look at our region's growth, because the growth continues to come. Water and some of those construction and materials costs will also continue to drive prices up for new construction. 2021 is really going to be a year of dust and dirt for Northern Colorado. While we've seen rapid timeline changes for developments, I mentioned rain dance. You know, I can reflect back just a couple of years ago when Martin Lind was giving us a presentation here at the group about this long vision project that would probably take somewhere in the neighborhood of 10 plus years to see to fruition. Well, rain dance is probably going to enter its completion phases sometime this year or in the next 2 years. That's incredible and not foreseen growth. And so catching up, 2021 is going to be a year where we don't see as much delivered product to the marketplace, but we're going to see a lot of dirt flying as many large-scale developments across our entire region start to take shape and form. I'd also like to take a quick moment today to just recognize some of our builder partnerships. Many of these builders are bringing new projects online and have provided much needed inventory to the Northern Colorado marketplace. Bessler Homes, Bartran, Bellissimo, Brandon Homes, Confluence, D.R. Horton, Front Row, Hartford Homes, Lennar, Mountain Standard Homes, Meridium, Naturecraft Custom Homes, Sage Homes, St. Aubin Homes, Stonefield, and Vance Construction. All great partners and really helped us provide some wonderful insights for this forecast. Want to talk about story number 7 tonight, and that's rents and vacancy. Every year we try to give you guys some sort of insights into what is happening. So for our investors out there who might have a portfolio of residential investment, for many people that might not be homeowners that are interested in what is happening to rental rates. You know, rents and vacancy are important. This year, rental markets have been impacted tremendously as many people have struggled to pay their rent with loss of job, with hardship, with being furloughed. Many people haven't been able to pay their mortgages with mortgage forbearance and other things. And so looking at the trend for Colorado, I'll talk at a state level. We currently sit at a vacancy, and now this data is current through, I believe, June of this year. So we won't have some of the other fallout. I wish I had more current data for you, but it's only produced, a couple of months going back. So I'm only through about the second quarter here, so at least gives us some insight into the pandemic. But Colorado's at about a 4.9% vacancy rate with the rents through the second quarter at about $14.47. So rents have held steady because we still do have a heavy demand. We've seen a lot of commercial development around multifamily, and we've talked about this in years in past, that many people have tried to figure out why we're building so many apartments and so much multifamily development. And most of it is because most of those developers have seen the inventory shortage and really where we're headed of people wanting to live here, but housing prices as well as availability being challenges. So many people will choose to rent and find living arrangements in multifamily. Let's look at rents and vacancy rates by city. And again, this data is through the second quarter of 2020. But currently, like for Fort Collins, we sit at a 3.1% vacancy with average rents at $14.37. So I do want to point out this is not single family rents. We cannot get that data. There's nobody that is tabulating that. If you're interested in more location-based single family resident rental rates, we have an amazing property management company, the Source Property Management. They'd be happy to answer questions. There's also great resources out there online to learn a little bit more about your exact neighborhood's rental rates. Looking at Loveland at $1,451 in average rent, 7.5% vacancy, so a much higher vacancy rate. $1,194 for Greeley in terms of average rent with a 4.3% vacancy. And for the statistical nerds, we know that this is very localized, and so this is Fort Collins rents. They do break this information out by region of Fort Collins. So the Northwest region at $1,482 at 2.6% vacancy. The Northeast section of town at $1,254 in average rent at 2.7% vacancy. And then the Southeast at $1,375 at 2.1% vacancy, and the Southwest area of town at $1,504 in average rent at 5.1% vacancy. So we'll continue to watch these trends. What we forecast moving forward is rents to remain fairly flat as many people kind of sort out the impact and the effects of the pandemic. There's amazing work being done in our communities by nonprofits like Neighbor to Neighbor who have been pivotal in helping with rental assistance and mortgage payment assistance for so many homeowners that have come under hard times as a result of the COVID-19 pandemic and its impact economically. So now finally, we're going to finish up tonight with our Boulder benchmark. For anybody new to the forecast, this is something that we do every year. And we take a trend line and we look at the same house built by the same builder, built in the same period, and we look at it in three marketplaces. So back in the 1950s, Wheeler Construction built in three areas. One is in Greeley, one is in Fort Collins, and one is down in Boulder. Same house, same product. They are really nice, well-built brick homes, and so they take the same characteristics, so we're able to track and trend prices over time by region. So this year, I'd like to take a look at the Boulder benchmark for Greeley. So this year, our Wheeler Construction home was 2432 13th Avenue. It was 1,000 square feet, just a little bit over 1,000 square feet. This sold on November 20th of this year, and it sold for a price of $295,500, and that is a dollar per square foot value of $291 a foot. Let's take a look at the same house, same construction, same basic size, built in Fort Collins. So this property was at 408 Duke Lane, 1,026 square feet. This sold on August 3rd of this year, and it sold for $435,000 at a price of $424 per square foot. Now let's take a look at Boulder. Same property. This property is at 360 South 42nd Street. 1,150 square feet. It sold the last day of the year, December 31st of 20, and it sold at $783,000 or $681 a foot. So taking a look at all three of these, we can see that, just 10 years ago, 2010, Boulder was at that $400,000 mark. Fort Collins was at the $200,000 mark, and Greeley was at about $120,000 mark. And now you can see their trend line. An interesting thing I would like to point out about Fort Collins this year is condition matters. Last year, we took a comparable in South College Heights, and that price was $475,000. It was really a cream puff. It was a property that was really well remodeled. It was a property that was well staged. It was well photographed, and that had a really big impact. This year, we didn't see as much turnover in that market, and our comp came back down. Didn't mean prices came down, but I think the lesson here is that as we look at these, condition matters of the home that you put out there on the market. But we continue to follow very closely the trend line of Boulder's growth in prices here regionally for each one of our marketplaces. And this is a really fun statistical benchmark that we can come back and look at year over year to see how our market has shaped up. With that being said, I would like to end this presentation by saying thank you. Thank you to Erica Martinez and Colorado Staging and Design for our beautifully staged set. Thank you to our customers, thank you to our friends, thank you to our neighbors. Without you, none of this would be possible. We live in an amazing place, and we're very grateful and fortunate to live in such a beautiful place. We all make a difference in what we do in giving back to our community. I would like to thank our partners here at the group for all that they do to hopefully add value and bring value to you and your families. I'd like to thank all of our internal teams here at the group that put on this presentation and this production. And we just thank you for your business. We thank you for trusting the group. We thank you for your friendship. We thank you for your kindness. And we thank you for all of the impact that each of you at home makes in Northern Colorado. We hope you found some information tonight valuable, and we look forward to seeing each and every one of you in person sometime soon. So everybody, please be safe, stay positive, and thank you for tuning in.